Dale, I know who he is.
Good afternoon, everyone. I am Robin McLaughlin, Associate Alumni Director here at Northwood University. Thank you for joining us today for our April Alumni webinar, To Free Trade or Not Free Trade? That is the question, with our esteemed speaker, Dr. Tim Nash. Before we begin, I'd like to remind you that if you have any questions during today's webinar, please use the Q&A feature to submit those. We'll have time at the end to address your questions. It's my pleasure to introduce our speaker today. I know many of you already know Dr. Nash, so I'll not give his whole bio, as I know you're eager to hear his presentation. Dr. Tim Nash is Senior Vice President Emeritus and Director of the McNair Center for Advancement in Free Enterprise and Entrepreneurship here at Northwood University. Now, please join me in welcoming Dr. Nash.
Thanks, Robin. Dan, can you put the next slide up? All right, gang, for those of you that know me, this won't be new to you or unusual. For those of you that don't, during my teaching days, two of my favorite people, my favorite president, my favorite economist is Milton Friedman and Ronald Reagan. And here's Dr. Friedman's famous quote: "If you put the government in charge of the Sahara Desert, within a short period of time, we'd have a shortage of sand." And Reagan's famous quote: "Hello, I'm here from the government to help you." And that's the hat that I'm wearing today. So with that in mind, and we're talking about a very interesting and popular topic today, U.S. trade policy and tariff policy. I would ask you to think about what happened the last time we got into a trade war, which I unfortunately think is possible. As my mentor and friend, Dr. Friedman, noted in his famous book, A Monetary History of the United States, with the esteemed researcher Anna Schwartz, that the Great Depression was caused by improper U.S. monetary policy. It wasn't caused by tax policy. It was caused by improper monetary policy, but it was exacerbated by the Smoot-Hawley tariff of 1930. And the economy really didn't start to turn until the Smoot-Hawley tariff was greatly reduced in roughly 1936. So with that in mind, or with that as a backdrop, what I'd like to say to you is that there are a lot of signs that we should be worried about the economy. The Federal Reserve's of Atlanta's GDP Now indicator, which the revised variable is supposed to come out today. It wasn't out at the time of this talk, but it is calling for a negative 3.7% GDP for the United States in Q1. Part of that is due to President Biden's policies of his last year in office, but also part of it is being influenced by trade policy. The markets, business in general is not really reacting positively to what's happening with trade. And if you take a look at an example of this, if you just take our neighbors to the north, Canada. We're talking about Canada. We're saying how bad things are with Canada, how unfairly they trade with us. And it's true that we have, if you go back to the finalized numbers of 2022, we had a negative, roughly $52.5 trillion trade deficit with Canada. We were 80 billion. We were 80 billion negative in goods and roughly little over 27 in positive in services. So overall, the negative, when you compare the goods and the services, which is the balance of trade, goods and services, we were positive in services, negative in goods, and we had an overall negative balance of trade with Canada of $52.5 billion. The real issue, though, to take a look at is if you then compared the flow of foreign investment or assets, and that's measured on a cumulative basis, not annually like goods and services. That same year, Canada had $600 billion invested in U.S. assets, and the U.S. had roughly $450 billion in assets invested in Canada. So the net difference of the assets over time favored Canada having 150.5 billion more in assets invested in the US than we had in Canada. But if you take it even further, in 2022, if you divided the population of Canada into the trade with the United States, and you did the same with the population of the United States, Canada, a 40 million person country at the time, was buying $10,800 worth of goods and services per capita from the United States, while the United States at the time, a roughly 340 million person country. If you looked at it, you'd find the Americans were buying $1,415 per person. So 40 million person Canada was buying $10,800 of goods and services per capita from the US. 34 million person United States was buying 1,400 and somewhere between 15 and 25. So give us the higher number, $1,425 of goods and services per capita from Canada. Again, if you look at it, it doesn't make sense to me that we have such difficult trade policies in place with Canada as we look at these kinds of numbers or figures. Also, take a look at what's happening with the Conference Board, the University of Michigan's, their consumer sentiments indexes that measure a wide range of short-run and long-term feelings of our customers. They're both down dramatically in the last couple of months. If you look at the National Federation for Independent Business, that index represents small business. And as I'm sure you know, small business represents about 80% of US GDP. And as you analyze that, the real problem, if you're saying on a broad-based level, you're saying that the U.S. Small Business Index is looking at a bleak U.S. picture. It represents 68% of U.S. GDP, and it's been down quite a bit, especially forward-looking. So these are difficult signs when you're thinking about trade and trade per capita versus trade total. You're thinking about consumer sentiments, and you're thinking about what small business is saying about the economy. If you look at the price of gold has gone up dramatically in the last year. It's up almost 40%, and it's up over 21% so far this year. And gold is purchased for three reasons: industrial use, everything from jewelry and chemicals to aerospace and other types of production in the area of microprocessors and things like that. And so if you look at the first reason to purchase gold, that's usually pretty stable. The other two reasons are the reasons why the price of gold is up so dramatically. The second reason that people purchase gold is they're worried about inflation and they're worried about economic instability. And the third reason people purchase gold is they're worried about foreign conflicts and foreign trade issues. And so the last two are the key reasons why gold has picked up through the Biden administration, and now why they continue to pick up in the Trump administration. There was a terrible tariff or a terrible inflation problem, we all know, during the Biden administration, and they're worried about inflation picking up, and they're worried about trade policy and instability, at least part of it due to tariffs. So gold becomes a key factor to take a look at. If you look at, we should be on the second set of slides, Dan. If you look at, just take a look at or think about what's happening with the stock market today. The stock market is falling through the floor. All major stock indices are reacting to the president's new tariff policies introduced last night. And if you look at it, the Dow Jones is down almost 1,500 points just before this webinar started. The S&P 500 is down over 6%. Again, the Dow Jones is down almost 5%. The NASDAQ and the S&P are down dramatically. And so, as you look at it, the S&P is down 4.02% in not even one day, not even 24 hours. 4.2%, the S&P is down 3.38%. The NASDAQ is down 5.17%, and the Russell 2000 is down 6.14%. So the markets are not reacting very positively to what's happening in the economy. And if you look at a number of other variables, and you're thinking about what's happening where it relates to the different types of trade issues or trade variables, the biggest problem that I think that we need to take a look at or talk about that we haven't is that if you're thinking about why the problems continue to exacerbate, I really believe it's the fact that a lot of us voted for President Trump. We believed in a lot of the president's policies, and we felt that there was a tremendous amount of things that we could be proud of, that we would be positively focused on. The real problem today is that as you support or believe in the president's policies on taxes, on regulations, on cutting government spending, border policy, generally foreign policy, the real key that comes into play is that the real issue is we're counteracting all the good opportunities that will come to the economy relative to lower taxes, lower regulations, reduced government spending. We're counteracting all of those because we do not have the ability to get those through while we're spending so much time and effort trying to rationalize tariffs. So I really think that when you're looking at the stock markets and you're analyzing what's taking place, the biggest issue as we look to what's happening is that the greatness, the strength of the United States has been invention, innovation, competition, and productivity. And it's allowed us to outperform the rest of the world in a very effective and efficient way. If you look at manufacturing has increased in this country by 50% since NAFTA. The problem with manufacturing, and even in the auto industry, the president was focusing on the UAW. The point is, our automobile production is roughly where it was when NAFTA was passed in terms of total number of jobs in the auto industry. But a lot of those jobs have moved to the South, to Ohio, to companies like Honda, Toyota, Nissan, BMW, Mercedes, and these are all non-union plants. And so the key is, will a push in terms of getting more automobiles back to the United States, what's it going to mean for American production of automobiles? How quickly can we build a new plant? If we build a new plant, will the plant be in Michigan, as an example? If we build a new plant, will the plant be high-tech based and need many fewer workers to produce the products in the plant? And another example is, will the plant be unionized? there's a lot of things that seem to be pushing and pulling to put this tariff and trade policy together, and a lot of it is kind of difficult for me to understand. And so, one of the things that I hope we can get to during Q&A is that we're going to spend some time and we're going to look at the components that make up trade, why we're in the situation that we are with trade. Should we treat some of the countries a lot differently, especially Canada? And moving forward, I certainly am not against trade barriers and restrictions on trade, for example, with China. I think that if I had been the president when it came time to allow China into a number of the World Trade Organizations, if I had signed on to it, I would have forced the fact that the Chinese needed to adhere to generally accepted accounting practices for all of the companies that were trading in the U.S. If these companies were involved in doing business on our exchanges to raise money and capital, they would have to meet our standards, especially the GAAP standards. When we know that the Chinese are stealing intellectual property rights, that's when I think you need to hunker down on trade with China and force them, even with tariffs, to do things to amend for their intellectual property theft. And when it comes to national defense, the Chinese have made a number of statements that are against the U.S. and against the best interest of the U.S., both foreign policy and in terms of national defense. That is certainly a reason to not allow U.S. companies to invest in China, to produce in China, to create a China-dependent value chain, especially for things like pharmaceuticals. So, in other words, to trade or not to trade, to be free trade or not, I'm a huge believer in free trade. Some of you know that Milton Friedman, my dear friend, wrote the foreword to When We Are Free. He had a great influence on my teachers at Northwood, like Orval Watts and Dale Haywood and Larry Reed and John Pafford. And I know that Dr. Matchek and Dr. Tokaroff and many of the other fine econ faculty that we have are big fans of Milton Friedman and his policies on monetary systems and free trade. That's what I think we need to get back to, not what I would describe as an thoroughly thought out, I'll just leave it at that. A trade policy that I think should have either been delayed and or more thoroughly thought out before it was implemented. So I guess my conclusion is that as you look at the trade right now, I am a big fan of the president's tax policy, the president's regulatory policy, the president's fiscal restraint policy, including the national debt and government spending, border policy, and just about everything he's done foreign policy-wise. I do not like, for the number of reasons I mentioned today, the trade policy. And I also think the president's going to have to spend some time looking at some of the numbers that he's listed as tariffs. Just take a country like Switzerland. Trade.gov, which is the U.S. government's federal trade website, it shows that trade with Switzerland being such. Switzerland, according to trade.gov, has an average 1.7% tariff on U.S. goods and services. Yet, according to the president's formula, which a lot of people are questioning this morning, shows a trade deficit or a tariff barrier level with Switzerland of 61% on U.S. goods going into Switzerland. The same website shows an average tariff on U.S. goods going into Taiwan of 6%. And yet the president's figures yesterday show the tariff burden or barrier on U.S. goods going into Taiwan of 32%. So trade.gov says Taiwan 6%, and the president's daddy yesterday reported 32%. So those are two numbers that are going to have to be straightened out as well. And with that in mind, I hope we have some time for Q&A. I know I've gone a little fast. I didn't think I was going to be able to finish it this quickly, so I apologize for any confusion. So if you have questions of clarity or of content, let's get started.
Thank you, Dr. Nash. Just a reminder to everyone, our webinar is being recorded. So if you joined late or had to step away, we will send out the recording after the webinar, as well as the two co-authored articles that are similar that Dr. Nash wrote about. We'll include the links to those so you can read them up more on those. Yep, if you have any questions, please use the Q&A feature to submit those, or you can throw them in the chat as well. We had LaShonda just make a comment that the problem is that the trade modifications, oh, it just moved on me, have not benefited the U.S. by large.
Was there a question in there?
No, I think she was just making a statement.
Okay.
Yeah, maybe just if you could comment on the same. She also put that she supported President Trump's bold actions to close trade deficits in the U.S. Trade has decimated our urban areas in the U.S.
I would say that what we forget about is that free trade and more negotiated trade has led to a lot of business in the United States. And what I also think is important to note, we import $4.1 trillion in goods and services from foreign countries to the United States, but we export $3.2 trillion of U.S. goods and services to the rest of the world. And if we don't think that the countries that we're putting tariffs on are going to retaliate, we're sadly mistaken. And we are going to see a negative impact on a number of different businesses and industries. Certainly agriculture, we export about 25 to 30% of all the agriculture we produce. And foreign countries are going to tariff that as a response to our tariffs on their products. Also, things like liquor. We export a tremendous amount of Kentucky bourbon, as an example, from the U.S. to Asia and to Europe. And they're certainly going to tariff that at a very high rate. So there's going to be a tit for tat in this, and it's why I brought up at the beginning the Smoot-Hawley tariff. There's a good chance that we are going to see individuals, countries, and trade blocs like the European Union respond collectively against us, I'm certain.
All right, we got two questions. One says, thank you for your timely and informative presentation. What are your views as to how long it will take our automotive industry to build manufacturing facilities in the U.S.?
Well, there's 2 points that people are making right now. One is that we have some current factories that are underutilized or not utilized at all. And the hope is that some of those could be converted to produce new products or products that we brought back home. I think that is going to, that would take a year to a year and a half. And to build a new factory, to get all the permits, to get all of the individual things associated with it, that could take 2 to 3 years. And by the way, it's now going to be more costly because of all the steel tariffs that we have. So that's where I think we're looking at it right now. The other thing that has not been finalized, and a number of these trade agreements will not be finalized for at least another week, which you hope means there's going to be negotiation between now and then. If we stick to a real strict reading of the USMCA, the United States, Mexico, Canada agreement, which was the trade agreement President Trump negotiated in 2020 during his first term in office. Right now, there's differing opinions as to how things will be finalized. But right now, a lot of American plants depend on parts from Canada or from Mexico to build final products in the United States. And, those parts could go up to a point where it may negatively affect automobile production on a grand scale. So we're supposed to get the final words on automobiles and the USMCA in the next couple of days. But we think too much about what we're bringing in relative to what we're exporting. But a number of automobiles that are assembled in the U.S. today are, as an example, the average, I believe the average General Motors car is only 58% domestic content. And the average that's the average General Motors car. The average Ford car is about, anywhere from 59 to some of them are as high as 84% for Ford. But what do we do about the parts that we don't currently have and we're not making in the U.S. To bring existing cars to production and to the consumer? That it's going to be a challenge.
Yeah, another question from Grant. How much do you expect the inconsistency of Trump's tariff policy magnifies or minimizes the tariff effect?
Read that one more time.
How much do you expect the inconsistency of Trump tariff policy magnifies or minimizes the tariff effect?
Well, I think the inconsistency is why you see the stock market down. And I think that it's one of the reasons why people are not buying as much, why the consumer sentiment indices, both the Conference Board and the University of Michigan's, people are waiting, they're worried about what's going to happen. And so they're not buying the way they used to. And that's not just automobiles. That's things like vacations are going to be negatively impacted. Buying other things like buying a home. If you're worried about buying a car, you may say, I may need more money for the car. And if the car is more important than the new home to your family's daily travels and your work-related issues, you're gonna wait, save your money, and that'll have a negative impact on not just the auto industry, but the housing industry. So I think it creates a lot of uncertainty.
All right, we got another one from Dora. She just retired from one of the big three automotive companies. The primary automotive companies, the OEMs, and trickle-down suppliers, dealers, etc., are also impacted, have expended an extraordinary amount of time and millions of dollars trying to pivot, prepare, and respond to some of the yo-yo tariff decisions that I have made, which in impacting the GDP. Do you think the tariffs could potentially lead us into a recession?
I think the answer, unfortunately, is yes. It's a great question. And the short-term effect is going to be higher prices to the previous question, which that inflation could easily cost the president and the Republicans the midterms in 2026. But in terms of the last question, the difficulty is that I think if there are two major definitions of a recession, and the one most used in principles of economics when I taught was two negative back-to-back quarters in GDP. And if you use that as the measuring stick, there's a real good chance that we could have negative GDP in the first quarter, and likely we could have it in the second quarter. So I'd say, unfortunately, I think there's a better than average chance we'll have some sort of a recession in 2025.
Dr. Tokaroff asked a question. How likely is it the other countries will blink first and remove their barriers so we can lower ours and finally get free trade?
Well, I hope, to Alex's question, that we have a number of countries that will get a chance to negotiate with the president. That's why with a number of countries, these don't go into effect until roughly April 9th. So I hope that happens. And I think it will happen with a few countries, maybe even Canada would be the one I would hope the most it would happen to and with. But I would say there's a chance that it'll happen with 5 or 10 countries, but it will just continue to create uncertainty. And then when some countries get a special break and others don't, what I worry about over the long term the most is the allegiance and alliances we have with a lot of these countries could very well be damaged by the trade policies.
How would you a consumer abroad, such as France, or how would you consumer abroad, such as in France and Brazil, view and compare an American product versus a Chinese or European alternative? What are your views on global competitiveness in regards to these tariffs?
Well, I would say that number one, when you look at a number of European countries, they truly need to look in the mirror because they have had large tariffs on us for a long time. And if I might give you another little economic history lesson, at the end of World War II, when Asia and especially Japan was devastated by World War II, and much of Europe was destroyed by World War II, the U.S. at one point had, over 70% of the global GDP and was supplying a lot of goods and services to the world. And ever since, and we, by the way, encouraged these countries to have trade barriers as they were rebuilding their countries and trying to get back to their old economic levels of production to focus on rebuilding their internal countries. And so as that happened by the 60s and 70s, and maybe at least by the 80s, we didn't see a number of these countries lower their tariffs to par with the US. And it should have happened in the 70s and even in the early 80s. And so I do think that there's going to be, in some cases, these countries will turn to other trade partners. And China is hoping that they are going to be a new trade partner and replace the United States in a trade alliance in Europe and quite frankly, South America and other places.
All right, one more question. Milton Friedman argued that tariffs harm the country, imposing them as well as other countries, and that unilateral free trade benefits a nation even if other countries do not reciprocate. My question is, what is your position with Dr. Friedman's philosophy?
Well, what Dr. Friedman is saying there is that what often happens in terms of free trade, even if you free trade and you're taking advantage of a bit, you become better, you become more competitive. You have to be the best at what you do, and as a result, you are able to and better at competing globally. So that's the first point I would make. The second point is that when you're looking at where we are today, in many cases, we would never have become as good as we did had it not been for open and free trade. And by the way, if you go back, a lot of the listeners may not remember this, but the United States invented the personal computer. The United States invented much of the early software, especially for business. But what we found out was that most Americans could not afford to buy a laptop. They couldn't afford to buy a cell phone. And what happened is we decided, on the one hand, if other countries could produce it at a lower price and more Americans bought PCs or bought cell phones, then we were going to make the money on the higher order, more profitable items, such as all the software for laptops, etc. But imagine if a laptop, we hadn't had open trade with laptops and open competition, and in some cases, offshored some of our laptop production to bring the price down. Think about education today. Think about business today. If laptops were 3 or 4 times higher than they are right now, then all the great software and all the innovations and the advent of AI would have come a lot slower or not at all without free trade. So free trade's not perfect. Dr. Friedman was not saying that, but he was saying, as he studied it extensively, all things constant, you're better off in a free market, only using tariffs and trade barriers for national defense to protect your markets, and then being the best you can be and the most competitive you can be so that you continue to produce the higher order items that make the most money for your economy. And quite frankly, help the rest of the world economy do better as well.
Thank you so much, Dr. Nash, and thank you everyone for joining us today. As a reminder, we will be sending out the recording and also information for our next webinar and the two articles that Dr. Nash recommended reading. I hope everyone has a great day, and we look forward to seeing you guys soon.